Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden within all the corporate jargon. And this latest report from LTC Properties is no exception. I've got to say some of these numbers from a healthcare real estate trust, especially after all the market changes, are quite interesting to say the least. All right, we're diving into LTC Properties quarterly report for the period ending June 30th, 2025. If you're new here, make sure to hit subscribe because we break down these filings into plain English so you know exactly what's going on with these companies. And hey, if you want to go even deeper, join our Discord link below. We discuss these kinds of reports there all the time. Let's jump straight into the core of it. Their balance sheet gives us a snapshot of what they own and what they owe as of June 30th, 2025. Compared to the end of the previous year, their total assets were around 1.8 billion, which is pretty stable. But check this out, their real estate investments, specifically operating real estate property net, saw a slight decrease from about 925 million to 865 million. This means they likely sold some properties, or maybe their value has decreased slightly, which is something to watch. Now let's talk liabilities. Their total liabilities also saw a slight increase from 733 million to 750 million. This is mainly due to their revolving line of credit going up from 144 million to 168 million. This suggests they might be using more short-term borrowing to fund operations or investments, which is pretty standard, but we always keep an eye on that debt level to make sure it's under control. Here's where it gets interesting, the equity section, and specifically a look at their common stock tells a story. Their number of shares outstanding increased from around 45.5 million at the end of last year to over 46 confirmed later in the report. This is a key area to understand how they're managing their ownership structure. Now let's look at how they're actually making money. Their income statement for the 3 and 6 months ended June 30th shows total revenues of about 60 million for the quarter and 109 million for the first half of the year. This is a decent chunk of change and it's up from the previous year, which is a good sign. Their rental income is a massive piece of the pie at over 30 million for the quarter. It's actually down slightly from last year, although this is explained by some property transitions as they embrace a new business model. What's really picking up the slack though is resident fees and services, which jumped from basically nothing last year to almost 12 million this quarter. This reflects their new strategy of operating some properties directly or through management agreements rather than just leasing them out, a big strategic shift. And then you have interest income from financing and mortgage receivables. These are essentially loans they've made to healthcare operators and properties. That financing receivable interest income alone is over 7 million this quarter, which is a significant amount, showing their diverse investment strategy beyond just owning properties. On the expense side, their interest expense is around 8 million for the quarter, which is down from last year. This is good because it means their borrowing costs are decreasing or they've managed to pay down some debt. Depreciation and amortization is also fairly steady around 8.7 million. Putting it all together, their net income for the quarter stands at about 16.5 million. This is a decrease from roughly 19.7 million last year. While any decrease needs attention, it's important to remember they're making strategic moves like the new rider structure, which can impact short-term earnings for long-term gain. Let's check the statement of equity to see how the company's ownership structure has changed. Remember that number of shares outstanding we saw earlier? It's reflected here as common stock shares issued increasing over time. Their cumulative net income is growing, which is positive, showing they are profitable over time. However, we also see cumulative distributions, which are essentially dividends paid out to shareholders. These distributions are substantial and represent a significant cash outflow, which is expected for a REIT focused on returning value to investors. And then there are non-controlling interests. This represents the portion of equity in their consolidated companies that doesn't belong to LTC Properties. It's a fairly small part of their total equity, usually around 87 million, which is fine as long as those partnerships are performing well. Now for the cash flows, this is crucial because it shows the actual cash coming in and going out. Operating activities provided about 59 million in cash for the first half of the year, which is up slightly from last year. This shows a healthy cash generation from their core business. Investing activities used up about 26 million for the first half of the year. This is primarily due to investments in real estate capital improvements, which means they are reinvesting in their properties to maintain or improve their value. Also, they invested in financing receivables, again showing that loan making activity. Financing activities used a significant amount of cash, especially because of repayments on their revolving line of credit and senior unsecured notes. They also issued stock raising about 13.7 million. The net result here is that financing activities used about 34 million in cash for the half year. This section talks about their segments. They've got two main ones now, real estate investments and their new seniors housing operating portfolio or shop segment. The shop segment is new and it reflects their shift towards managing properties directly or through management agreements. This is a big change in their business model and it's exciting to see how it plays out. Under their real estate investments, they own 108 properties leased out under triple net leases. This means the tenants pay for most of the operating expenses, which is good for LTC. They also have 13 properties in that new shop segment. Looking at their owned properties by type, seniors housing makes up about 54% of their investments, with skilled nursing coming in at 45%. This is a pretty balanced portfolio between the two types of healthcare facilities. They have 7 properties being held for sale with a gross investment of about 71 million. This is a common strategy for REITs to sell off underperforming or non-core assets to redeploy capital into more promising investments. For acquisitions, only mentioning one small purchase in 2024 and nothing significant in 2025 so far in terms of new property acquisitions. This suggests they are focusing on optimizing their existing portfolio and integrating their new shop segment. Then we have their financing receivables, which are essentially loans backed by properties. They have a significant portfolio here with over 361 million in financing receivables. This part of their business is crucial for generating interest income. Their mortgage loans receivable are also substantial, over 353 million. What's interesting here is that one particular loan with Prestige Healthcare has a variable interest rate with annual increases. They amended this loan subsequent to June to revert to the full contractual interest rate of over 11%, but Prestige has an option to prepay it without penalty. This shows the complex negotiations and financial structures they engage in. Notes receivable are also part of the mix, including mezzanine loans and working capital loans. These are typically higher risk but higher reward investments. They have credit loss reserves set aside for potential defaults on their loans. They are actively managing these reserves based on expected losses and economic conditions, which is a sign of prudent financial management. Let's Talk Debt LTC has an unsecured credit facility providing significant borrowing capacity. They've also entered into new credit agreements to increase this capacity and extend maturity dates, which is good for long-term stability. They use interest rate swaps to manage their exposure to interest rate changes, especially on their term loans. These swaps effectively lock in interest payments, which helps create more predictable cash flows. Looking at equity, we see their common stock shares increasing, which aligns with their at-the-market equity sales program. They are actively issuing shares to raise capital as needed. Their dividend payouts are also important. They declared dividends of about $500,000 per month, which is consistent and shows a commitment to returning cash to shareholders. They have stock-based compensation plans for their employees, which is standard practice. The remaining compensation expense for unvested awards is over 13 million, which will be recognized over the next few years. They have ongoing commitments for property investments and other items totaling around 66 million in remaining commitments for owned properties and significant commitments for mortgage loans. This shows they are still actively investing in new opportunities. Now let's get into the operator updates. Anthem Memory Care moved from triple net leases to their shop segment, which is a big operational shift. This transition led to some write-offs, but it's a move towards a more direct operational involvement. A critical piece of information here is that Genesis Healthcare filed for Chapter 11 bankruptcy. While Genesis has paid rent through August, this is a significant risk factor for LTC as Genesis is a major operator. Its financial health directly impacts LTC's revenue. Prestige Healthcare is their largest operator, and they've had some complex loan negotiations. The amendment to their mortgage loan is a good example of how they manage these relationships, renegotiating terms to potentially benefit both parties, while also introducing new risks if prepayment options are exercised. Overall, their portfolio is diversified across 25 states and 29 operators. This is good diversification, reducing reliance on any single operator or geographic region. Looking at the operating results quarter over quarter, rental income is Slightly down, but their new shop segments resident fees and services are booming, making up for it. Increases in financing and mortgage interest income are also positive signs of growth in their lending activities. The net income decrease this quarter is mainly due to those one-time costs associated with the Genesis healthcare situation and the transition of Anthem properties. Excluding those specific events, their underlying operational performance seems stable. Let's talk about FFO funds from operations. It's a key metric for REITs, and theirs is about 23.3 million for the quarter, up from 28.4 million last year, although it's important to note the increase in depreciation, amortization, and the gain on sale adjustments are impacting this number. Their net operating income, or NOI, is around 48.4 million for the quarter. This is a crucial measure of the profitability of their properties before corporate expenses. It's up from last year and shows the core rental income is strong. For liquidity, they have about 640 million in readily available cash and credit lines as of June 2025. Plus, they have access to over 376 million under their equity distribution agreement. This is a very strong liquidity position. Their debt to gross asset value is around 31.3%. This is a healthy leverage ratio, meaning they aren't overly burdened by debt relative to the value of their assets. This level is well within their debt covenants, and their interest coverage ratio is a strong 5.1 times. This means they generate more than enough earnings before interest, taxes, depreciation, and amortization to cover their interest payments. In terms of market risk, they're primarily exposed to interest rate fluctuations, which is managed through their debt and swap agreements, as we discussed. They've reported that their management has evaluated disclosure controls and procedures and found them effective. No material changes in internal controls over financial reporting were noted. Now for the risks. The big one is that Genesis Healthcare bankruptcy. This could really impact LTC's revenue if Genesis struggles to pay its obligations. They also mention potential government regulations impacting REITs in the healthcare sector and the added operational and legal risks from their new REIT properties. So far, they've done a good job adapting to the new REIT structure and diversifying their revenue streams. The slight dip in rental income is more than made up for by the growth in their operating portfolio and interest income. The Genesis bankruptcy is a significant concern though, and will be key to monitor. Overall, LTC Properties seems to be strategically navigating a complex industry. They're managing their debt while their liquidity is strong, and they're diversifying their business model. The Genesis situation is a cloud on the horizon, but their proactive management of REIT properties and strong core business suggest an ability to weather challenges. Alright, that's our breakdown of LTC Properties' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.